everyone, and welcome back. Today we are going to be talking about all things credit. Credit often gets a bad rap, and the thing is that credit is really important because it's part of your financial picture and it helps you actually access things like loans for a mortgage, loans for a car, and other big ticket items. So, credit is actually really important. And so, we want to talk about actually how to best manage it and then how to leverage it. So, first, we're going to talk about credit scores and credit reports and understanding why those are really important to take care of. And then we're going to talk a little bit about how to improve your credit score and how do you manage your debt, in particular credit card debt. So let's get started. So, what is credit? Because we talk a lot about debt and we forget that credit and debt are related, right? So, credit is essentially any goods, services, and or money received in exchange for a promise to pay back a definite sum of money at a future date. And generally, that's with interest. And so when someone gives you a loan, a personal loan, right? So, I lend my friend $5 or $10. Generally, I'm not going to ask for interest, but I'm going to probably tell her, oh, just pay me back in a week. So that's credit. You're extending credit to someone. But when you're doing that with an institution like a bank or the federal government for your student loans, you are essentially signing a contract and saying, I am going to pay back this money over a specific period of time, and we have agreed on an interest rate. Now, it may not feel like you always are able to actually negotiate that interest rate, and most of the times you're not. But when you sign a contract for a credit card or a loan, you are essentially agreeing to that rate. So, what is a credit score and a credit report? Well, those two combined are essentially your financial resume to lenders. It lets someone know that, hey, I'm a safe bet. I'm going to pay back this debt. It's really important that you understand that the credit score and your credit report are really the only ways that a lender, again, an institution, a bank, the federal government, a school, is able to say, you are going to be safe. We're going to give you this money because you have promised to pay us back. So a couple of things that we're going to talk about today: a credit report, which is different than your credit score, paying down debt, and then leveraging credit. So now we know what credit is, and let's really focus now on why it's important and who are the players in the credit space. So you're going to hear a lot of different names of agencies and FICO score and all of these sort of terms and lingo that are associated with credit. So let's just get into that. Really important to first establish a credit history. You can do that in a couple of ways. If you are a renter, for example, you're going to put a bill in your name, an electricity bill or a gas bill. If you've never had a credit card before, one of the best ways to do that is to get a secured credit card through a credit union or a local institution. There are also secured credit cards online that generally charge a $50 to $100 fee. Now, the preference is to go with a secured credit card or a credit union, but oftentimes if you don't have that, then getting a secured credit card online through a reputable service, and we'll have some recommendations for you, is the best way to go. The other thing that you could do is if you have a parent, for example, that has a credit card, you can ask them to be an authorized user, and as long as that card reports out to your social security number, you will be building credit. How does credit get reported, and who are all the different players? So once you open a credit line, and again, a credit line can come in the form of a credit card. It can be a utility bill. It's your student loans, for example. If you have a car loan, any of those things can be reportable to a credit agency. So there are 3 credit agencies, and we'll talk about those in a minute. They are non-governmental, so they're private credit agencies, and they are like essentially a repository for all of your credit history and data. So they individually create credit reports. Companies like FICO then create the credit score. So on one hand, you have credit reporting agencies which collect data from all of the people who you have credit history with, and then that data is then converted into a credit score. Summarize the relationship between a credit agency and your credit score, because I want to really make sure people understand those are two different things. Your credit score is an actual score. It's like a grade almost, and we're going to talk a little bit about that, but they range anywhere from 300 to 800, 800 being kind of the best credit score you can have. Credit reporting agencies are the ones that collect all of that data, and there are three major credit agencies: Equifax, Experian, and TransUnion. When you go to pull your credit report, which we're going to talk about in a minute, you will be getting your report from all three of those agencies. The FICO score, or often referred to as just the credit score, is something that you can get actually for free most of the time. If you, for example, sign up for Credit Karma or for Mint, or you have a certain kind of a credit card, I think Discover is one of them, they will give you your credit score for free. It's called an educational credit score because it's not your final FICO score, but it's a good sense of where you fall in terms of your credit. And you'll at some point want to get your quote unquote real credit score from FICO, especially if you're going to buy a home. In the meantime, the credit score that you receive for free is good enough to just keep you on track and to make sure that you are improving in your credit score over time. So both your credit score and your credit history have a real life impact. I think credit is one of the most important things that you can take care of. The younger you are, where you're establishing your credit and you're taking care of it and you're using credit responsibly, the better off you are in the long term. It's a lot easier to establish good credit than to fix bad credit. But at the end of the day, even if you don't have a great credit score right now, there are things that you can do to hit reset and really get back on track. So what are some of the real life impacts of your credit score? One, insurance rates. So if you do go get car insurance, sometimes they will pull your credit report. Housing is a big one, both in terms of a mortgage, a loan that you get to buy a home, and for example, for a car loan. So both of those are what we call big ticket items. They're very expensive. Most people don't have enough cash, for example, to buy a home outright or even a car. So what you do is you get a loan from a lender. Well, those lenders, especially if you're getting a mortgage or if you're getting a car, they're going to look at that FICO score. But additionally, in most big cities, for example, if you are a renter, they are going to look at your credit score. There are some employers who will pull your credit report, especially if you're working in the financial services industry. In addition, when you have good credit, you will be offered a lower interest rate. The reason being is that a lender will look at that credit score and say, oh, well, this person pays their bills on time. This person has enough money to pay all of their debt. They have, a long credit history. So I know that I can trust this person to pay back what money we're lending them. So oftentimes a credit score with 700 or above is going to get a lower interest rate. What that means is that you as a consumer are going to pay less over time. You're also going to pay more fees in interest. So that's really important, that if you are offered a credit card and you have a low credit score, your interest rate is going to be much higher than if you have a credit score above 700. In addition, in the future, when you decide, or if you decide to refinance your student loans, your credit score is going to play a big role in the interest rate that you will get in your consolidation package. So for all of those reasons, your credit score and your credit history have a real life impact on asset building and building a financial future. So what's included in your credit report? There's a number of different items and they play different roles, and so it's really important that we look at each of them. When you download your credit report, and we're going to give you a link so that you can download your credit report for free from all three agencies, you're going to make sure that your personal information is correct. So your address, your name, your date of birth. Oftentimes, if you've lived in multiple places, they'll have different addresses for you. So you just want to make sure that the most current address and personal information is correct. It's going to have all of your account information for all of your credit cards, all of your loans, your student loans if you're already paying those back. So you want to make sure that there's nothing in there that looks odd. So this is where identity theft comes up. And if you see something in your credit report that you're like, I didn't apply for that, or I don't have that card, you want to take a look at that and dispute that, because that could be an identity theft. You're also going to see there any public record information. Those are things like a debt that you owed. Perhaps you were taken to court for that debt. If you were evicted, generally that gets reported also to your public record. You'll also see things that are called inquiries. So every time that you apply for credit, you will have an inquiry on your credit report. So that is actually why we tell people that you should not be applying for a lot of credit cards in a short period of time. In fact, you should wait at least 6 to 8 months before applying to different credit cards, especially if you've been denied for a credit card or a loan. Oftentimes now you'll hear people talk about soft pulls and versus hard pulls. Sometimes a soft pull will not get reported to your credit. So to make sure to ask if it's a hard pull or a soft pull, and just remember that every time you are applying for something, that it's going to generally hit your credit, and you don't want too many of those in a short period of time. So how long do things stay on your credit report? This is really important to understand if you have bad credit and are trying to improve your credit. So there are things like accounts in good standing. That's like a credit card that you have right now that you pay off every month. That's going to just be there. It's active. It's in good standing. If you have closed accounts that are in good standing, those will stay on there for 10 years. We actually suggest that you don't close accounts if they're in good standing. If you've been paying them down and you feel good about them, you don't need to close the account. You can just essentially put it away, don't use it too much, and put it aside. The reason being is that it interferes with your credit history, especially if those were very early credit cards that you had. You kind of want to keep them. You just want to pay them down, make sure that they're up to date and in good standing. So if you've missed payments and your credit card has already reported that, so what we call you've missed payments for 60 days and then 90 days, those types of transactions and payments are going to stay on your credit report for 7 years. So oftentimes you'll hear people in the credit repair space talk about the 7-year limit. If, for example, you've had a credit card that you didn't pay or that you made late payments on, and perhaps they closed it on their end, that's going to stay on your credit report for 7 years. You want to keep an eye on that, because after 7 years, they shouldn't be reporting it any longer, and you want to make sure that the credit agency knows that that debt has actually, that debt is actually 7 years old and it should be taken off your credit report. Public record information, again, will be talked about bankruptcies, any debts that you owe by law. Maybe a parking ticket sometimes can become part of your public record. Those things generally stay on for 7 to 10 years. And then we talked about the hard inquiries and the soft pulls on your credit report. Again, just an inquiry from a lender. If it was a hard inquiry, for example, if you went to go apply for a car loan and were denied, that's going to stay on there for 2 years. So it's really important if you see an error in your credit report to dispute that. You can do that very easily on the site where you're downloading your credit report. Generally, what happens is that you'll submit a dispute of an error. If perhaps it's a card that you don't recognize and it was identity theft, you'll identify it as such. And then the credit agency has 30 days to investigate it. And they will do a background check essentially on that report. If the error is found to be correct, then they will generally fix it, but you want to stay on top of this because it's not an automated process. So you want to make sure that in a month, if you haven't heard something back from them, that you go and you write them again and let them know that you haven't seen a change in your credit report. So that's how you dispute an error. There's also other agencies that we'll talk about in a minute who can often help you do this, but remember, you shouldn't be paying for this. It's free, and as long as you have backup information to support that there is an error on your credit report, you generally are going to be fine. And like I mentioned, there are credit repair agencies out there. Some of them charge a fee. Some of them are nonprofits. Obviously, I think that the preference is to go to a nonprofit credit repair agency. What they help you do generally is to collect all that information, your credit reports, make sure that you're looking at it, looking at errors, and they're going to help you essentially dispute anything that doesn't look right and hopefully get those off your credit report so you can improve your credit score. Just be careful to make sure that the debt repair agency is credible. I would look them up in terms of Consumer Reports. There's a number of free programs out there, so I would suggest trying to find those first before you pay anyone to fix your credit. So let's just talk about the credit score. Again, like I mentioned, there's a couple of agencies that provide the credit score. FICO is one, and then there's Vantage Score. And what you're going to want to aim for is to have a credit score over 700. Anywhere from 700 and 750 to above 8 is excellent. And these change a little bit. I mean, it's not always a stagnant number in terms of what's good and what's excellent. But if you have over 700, you're going to be pretty good. And again, you want to obviously strive to have perfect credit score. And you can see here that most Americans have a good credit score, not an excellent one. And this is really something that we want to make sure that you understand, that, you know, having a credit is something that you can actually achieve if you start early enough, if you really follow the rules around credit utilization, and you budget and you make sure that you're paying your all your bills on time. So you're going to aim for the 800, and I will say that anything in the, below 600, you're going to pay more for interest rates on credit cards. If you actually get approved, you're less likely to be approved for any mortgages or for a car loan, or if you do, you're going to end up with a very high interest rate. So if you are planning on buying a home or a car, I would suggest that you work on getting your credit score to at least 700 before you go and apply. You'll also hear a lot of people talk about good credit versus bad credit. And there's no rule around what that is. But there is some recommendations around the kinds of credit that you want to have. And just to be clear, there's two types of credit. There's closed-end credit, which is what you often refer to as installment credit, and that's mostly loans, mortgages, school loans, personal loans. It's a set amount of money that you are borrowing over a set period of time. Open-ended credit, which is revolving credit, are things like credit cards, because every month you pay that down and you get a little bit more credit. So you're all, that credit is always available to you. So that's revolving credit. So good credit. Mortgages are generally good credit. Even school loans are good credit. Personal loans, car loans, those are actually all good credit, because what you're saying to a credit agency is that I'm buying assets. I'm buying things that are worth money, and they're generally associated with people who are establishing a financial foundation. Bad credit is often thought to be things like credit cards that are, for example, from a consumer brand. So when you go to a shopping store, for example, I'm not going to name any names, and they offer you a credit card while you're checking out. That's generally not the kind of credit you want to establish. If you are going to get a credit card, you should really try to get one from either a bank or a credit union or an established financial institution. What happens is that when a creditor or lenders see that you have several different credit cards with consumer shopping companies, then it looks like you are using or spending more money than you're making, and it's very quickly going to add up, and you'll most likely be in a place where it's going to be very hard for you to pay down your debt. One of the reasons being is that those credit cards have a really high interest rate, so above 18%, where generally mortgages, school loans, even personal loans, and some car loans are going to be below 15%. You just want to make sure that you don't have too many of those, and really focus on getting what we call quality credit cards, either from a banking institution, credit union, or an established credit card agency. And oftentimes those are going to also bring better benefits. So when we talk about leveraging credit, we also want to think about credit cards as not necessarily a negative thing, but also something that if managed well, has some benefits like cash back or points and rewards on which you can travel. So we want to think about that as you start to build up your credit. So let's talk a little bit about building excellent credit. As you can see here, this image has us at 723, which we talked about. Above 700 is pretty good. That's where you want to be. And there's a number of factors that go into calculating your credit score. So let's talk about the factors that go into your credit score. First one being payment history. So this is really important, and essentially what it's looking at is, do you pay your bills on time? It's one of the most important factors in your credit score. It doesn't mean that you have to pay down all your debt every month. What they're looking for is, do you make that minimum payment and it's not late? And this is very easy to do if you can put your bills on auto pay. And we're going to talk a little bit about auto pay, but particularly for minimum payments. You're going to want to make additional payments if you are trying to essentially pay down your debt. But the most important thing is to pay on time. So making sure that you set your calendar reminders, or if you have auto pay, making sure that that is at least 1 week out so you never miss that payment, because even one missed payment can really hurt your credit score. So it's more important to pay on time than to pay a huge chunk of that debt. It is still important to pay down that debt, and there are ways to make additional payments in order to do that. Age and type of credit. Age is essentially, again, how long have you had credit. So if you have no credit, for example, you are still going to have a lower credit score. So they want to see that you've had credit for a long time, again, which is why we say don't close those older credit cards. And so if you started paying down your debt, it's generally going to take anywhere from 2 to 5 months to start to see that being reflected in your credit score. So one of the most important things is the credit utilization, and we're going to show you how that works. But you can see here, number one, payment history. Type of credit is, again, whether that's a loan or if it's a credit card. So if you have a lot of credit cards and no other sort of personal loans, mortgages, car loans, that is sometimes a red flag. The percentage of the credit limit used, and this is going to be really important, and you want to keep that credit utilization to under 30%. We're going to talk about that in a minute, so I'm not going to go too deep into that. Total balance to your debt. So they don't like to see you having lots of outstanding balances that are not getting paid down. So if you have more than 10 credit cards, for example, and they're all maxed out, that's going to hurt your credit score. They're also going to look at what they call recent credit behavior. That's the credit pools, when someone, again, has a hard credit pool on your credit report. And then they're going to look at available credit. This is, again, related to the percentage of the credit that you use. So again, be careful about maxing out your credit. So I want to take a moment to talk about compound interest. For those of you who've missed it in perhaps one of your classes, it is essentially a concept that Albert Einstein called the eighth wonder of the world. And the important thing about it is that it essentially allows your money to grow, because what it does is it takes your principal investment, and it combines it with interest every month, and that compounds over time. And as you can see, what happens is it kind of balloons, which can be really great if you're saving or investing. If you're not saving or investing, compound interest can actually hurt you. This is why people get into credit card debt. Compound interest can work for you or against you. So let's just say you put $1,000 into a high yield interest account. That $1,000 is called your principal. So with compound interest, that $1,000 would be growing 5% every month. The key thing is that it's not only is it getting 5% on the principal, but on the principal plus the interest that's growing every month. So if you look here, $1,000 is your principal investment the first month. The second month, you received $50, which is 5% of $1,000. And so now at the end of that month, you have $1,050. Well, the next month, the 5% interest is going to accrue on that $1,050, giving you $52.50 in interest. So your new balance is $1,102, and so on and so forth. So you can see how that grows over time, because it's giving you that interest is compounding on top of your principal plus the interest. It works for you by increasing your savings and investment over time, or it can work against you if it is compound interest inside of your credit cards. So let's just look at how that works. You have a credit card, for example, and that credit card is giving you $1,000 in credit, and you maxed out that credit card in the first month, and it was 29% interest. Then the next month, if you don't pay, it's going to compound. So it's going to be the interest payment plus the principal, the $1,000, and then it's going to be 29% of that amount. So you have to be careful with compound interest. Again, it works for you in investing and saving, and it works against you in any kind of debt, both credit cards and loans. So let's talk about credit utilization. Essentially, credit utilization is the amount of credit that you're using based on your credit limit. So, for example, take your credit card. If you have a $1,000 credit limit, using 30% of your credit card means that you are not going to use more than $333 every month. Credit utilization is a pretty simple concept. It essentially means that if you have a total credit line, for example, your credit card, you have $1,000, they don't want you using more than 30% of that credit. So 30% would be $333. Now, as long as you pay down your credit card to less than 30%, you're going to improve your credit score every month. The reason that the credit utilization is so important is that credit card companies don't want to see users using all of the credit every month. And because they also know that the more credit you use, the harder it is to pay down that debt. One of the best ways to improve your credit score is to make sure that for each of your cards, you're not using more than 30% of your credit. So let's take a look very quickly at credit card disclosures, because I asked a lot of people what interest rates they're paying on their credit cards, and most people don't know. So I wanted just to show people where you can find that on your bill. So this is just a general credit card bill, and you will see at the bottom there is an area that says your annual percentage rate for purchases. So that's the interest rate that you're getting charged generally every month by your credit card company on your balance. So when you're looking at what they call APRs, you want to shoot for an APR under 18%. So this one, for example, is 18 to 26%. Those that get the 18% are those that have better credit scores. And you can see that here. It says based on your credit worthiness. If you don't have good credit, then what they're going to do is charge you more. So it looks like they're going to charge you up to 26%. A couple of other things to note on a credit disclosure, credit card disclosure. APR for balance transfers can sometimes be different. A balance transfer is essentially when you pay off another credit card with a new credit card. A lot of times you'll have offers where it's 0% if you do a balance transfer, but you have to read the fine print. Those generally mean you have to pay that off in a shorter amount of time to get that very low interest rate. APR for cash advances, also really important. So if you take cash out in an ATM on your credit card, there's a different interest rate that applies. So cash is always a higher interest rate. So here you can see that a cash withdrawal or a cash advance is 27.49%. So I want to talk lastly about some miscellaneous credit issues. And those are just essentially things that are related to credit. So let's talk about being a cosigner or asking someone to cosign and what that means. So when someone doesn't have good credit, or they perhaps don't have enough income to get a loan, then generally what's going to happen is that the lender is going to ask for you to get a cosigner. This often happens in buying a car, buying a home. If you're renting an apartment, you'll also see this as well. And what it does is that your cosigner is essentially saying, I will pay this debt if this person fails to do so. So it's a big responsibility. If you are a cosigner for someone else, realize that if they don't pay their debts and the credit card or the credit lender ends up suing them, they can also sue you as well. So you want to be very careful with co-signing or asking someone to co-sign for you. So it's a very big responsibility. We talked a little bit about getting a secured credit card or a starter credit card. There's also prepaid cards. You have to ask and make sure that that prepaid card actually reports out to the credit bureaus if you're going to use one. They're sometimes called credit building cards, and they often have very high interest rates. So again, that should be a last resort. There's also a number of companies that provide alternative reporting, and that means that they're going to report out things like your rent payments or your cell phone payments to credit reporting agencies. And the reason that this can often be a good thing is that you can now start to build your credit beyond just your credit cards or your loans. It's actually using other kinds of data to show that you're a worthy consumer and that you're a responsible consumer and that you're going to pay back this debt because you're paying these other things like your rent and your utilities. So that sums up our credit discussion, and we hope that you got a lot out of that. And please make sure to leave any questions in the comments below.